I let algorithms trade for me. Here are my April results of running a portfolio of 10 automated strategies across the futures markets. That includes things like ES, NQ, CL, etc. Now, I've been trading for the past 6 years, and I now manage a six-figure portfolio that is fully automated. Now, while most traders really struggle during this new Trump era of volatility, I'm going to walk you through my results to see how my particular strategies performed and if they survived. So first, let's go over the equity curve. Now, this equity curve is produced by a software called Quant Analyzer. It's made by the guys at Strategy Quant, and I've been really enjoying it recently. I've been using it for the past couple of months. Primarily, what I do with it is I export out all my trades from NinjaTrader, which is primarily where a lot of these strategies are executed on, and then I put it through Quant Analyzer so I can see performance per strategy. I can see a correlation matrix, which I'll go over in just a second if you're kind of curious about that or you're not sure what that is. And it also produces this amazing equity curve as well that we get to kind of walk through each individual trade, and we can also do it by date as well. This particular one is by trade, just because I think trade is a better representation of seeing all the volatility within a portfolio. Now, as we can see here, as I was mentioning, that a lot of the returns came from this one particular day and kind of a couple very significant trades this particular month. So overall, the returns were 20.3% for last month, which was April. And I got to say, this is one of my best months pretty much ever. I think it's top 2 or top 3 best performance ever on a per month basis. And one thing to keep in mind, this isn't applied on notional value. This is obviously applied on my core capital in futures, and in futures, you get a lot of leverage. So please keep that in mind that this isn't on the notional value. If it was, the percentage would be a lot lower. And also, I have back tested my strategies and even forward tested as well to see how much size I could push through. If I tried to deploy 2 million, 3 million capital on this, slippage will primarily kill a lot of my strategies, which would obviously lower these returns. That is one key thing to always think about when someone is showing you your results or talking about results, is that they are often very liquidity or constrained to some extent and wouldn't work when you're deploying crazy amounts of capital. And that's why when you see, big hedge funds that are managing multi-billions dollars of capital, they're never going to get as high returns as this, unless, some maybe as market making, etc. And that's often because to get that much size actually deployed, there's very limited edges or even premiums that could actually handle that much size and give you solid returns. Now, on surface value, 20% in a month sounds absolutely incredible, and I would agree. It was really amazing to see and actually finish off the month at 20%. But to get to there, it was not that clean. I had a drawdown of 20.51%, which is, I think, probably one of my highest drawdowns ever in a single month. It was very treacherous. And this is where, as you can see, the performance isn't actually that impressive when you kind of think about it as a risk-adjusted return. Doing a 20% drawdown to get 20% return, while that's one-to-one, and also the return is very high, it was very difficult to stick through. Now, overall, this was done by 331 trades. Now, these trades were actually quite evenly played out. And if any of you have watched my previous recaps, one thing you'll notice here is this is pretty much all my strategies taking trades, even my swing strategies. Now, it's pretty easy to identify the swing strategies, like this one only has 3 trades and this one has 8 trades. Now, those are normally adding 2 positions. Technically, trades on here, I don't believe, are calculated exactly from opening the position to fully closing. For example, if I added multiple contracts along the way and then closed some, it would be counted as trades as well. So that's why it seems a bit higher than it actually is. But we will go over why this was actually so instrumental this month, of why these swing strategies were a key component, really, I would say, to this month, to adding up performance as well. Everything else, as you can see, is mostly intraday. I trade mostly intraday, but on higher time frames. That reason mainly being is because you get the best margin for the amount of leverage you get to be able to take on. And you don't have to put on as much margin when you're doing swing strategies, for example, where you have to put on a lot more, especially for like ES, NQ contracts, etc. Now, for the distribution of strategies, a lot of them were profitable this month, which was quite surprising to see. I was expecting a higher mix of that. We'd have a couple really key winning strategies like trend following, etc. And then the mean reversion strategies would get absolutely killed, for example, this month. That's at least what I was expecting, but that's actually not very true. So to go over a bit more detail, we can see the trades detail here. So overall, we had 154 wins, 177 losses, and the average loss was about 0.41%. Average win was about 0.6%. We had 11 consecutive wins and 12 consecutive losses. Now, if I was trading that manually, man, that would have been difficult to go through 12 consecutive losses, back to back to back. And that's why I trade algorithmically. I am terrible personally as a discretionary trader. I'm getting a bit better over the years, and obviously I've just seen more market experience now. But primarily, if I had to execute those trades myself, I'm 100% sure this probably would have been a minus 10% return this month. We can see the largest win, which was obviously very outsized, and that's primarily what I'm going to get into in just a second as well, was 11%, and the largest loss was 3.45%, and then everything else doesn't really matter here too much. Now, to understand these returns, we need to go through how the market actually performed in April. Now, if any of you are actually trading as well, April was a crazy month. We had the whole tariff speak. We had SPY dropping almost 20%, I think it was, in a couple of days. It was just incredible to see. Now, this is how the NQ market looked over that time. So we can see here, huge drop, huge rebound, and that was primarily all in one day. Now, can you guess where a lot of my returns came from? It's from this one green bar here. I believe on NQ it was up about 12%, if I'm not mistaken, right? Yes, it was the second biggest day ever on NASDAQ, and that was about a 12% return, and SPY went up almost 10% in a day, which when you play that out, an average return for SPY over multiple years is about 8 to 10%, give or take, per year. To see 10% in a day is unmatched opportunity, and what you could do on futures, especially with the amount of leverage you could take on, it was incredible returns. And that's why you can see, if I scroll back up to my RPC curve, pretty much all my returns came from this one day. If I actually just zoom in here a bit more, you can see I was about -4, I think. Yeah, -4 or 5% returns 1 month. And after that one day, I was at about 28, I think. And then I've obviously stalled down a bit from there. So just insane to kind of get returns from that one day. Now, as I do trade algorithmically, I will say that for the most part, I wasn't watching my actual account that day. I was watching the market because I think everyone was watching the market that day. It was just incredible to see that kind of price action. But once I had actually checked my brokerage account, or like my P&L after that day, it was a crazy day to feel. And I ordered myself some nice food that day, 100%. Now, if we get back to where I was just at, we were basically talking over how a lot of these returns came from one day. And it was actually a mixture of two things. I think when I was talking on a podcast I run with a friend of mine that's also a trader, I was saying that primarily a lot of returns this month were trend following. But after really going into it a bit further, actually it was kind of split. And the reason for that was because of swing strategies. So some of my swing strategies are mean reversion strategies, meaning that, we're looking for overextended or moves on upside and downside primarily. And I was quite lucky to get, I believe it was either on this day or is this day, one of my swing strategies to go long as well on this. And then obviously with this bar, a lot of my trend following strategies executed and went long as well. So it was kind of that double exposure amount. And this is also where, if we get into exposure or correlation, this month was terrible for that. Actually, just before that, let's go over to see how that performance ranks up between short trades and long trades. So we can see about 29% of my trades were shorts and 71% were longs. Now, the 71% is quite typical because most of the time, at least in indices, you're most likely going to be going long most of the time compared to doing shorts. Actually, getting returns on the short side is a lot more difficult, especially in indexes. So 29%, at least for me, is actually not too bad. I don't think I've ever been at like 50-50. I might have been at 1 month, but most of the time it's going to be a small percentage on shorts. Now, if we look at returns based on long or short, we can see primarily everything was long. I basically didn't have to go short at all this month, and I probably wouldn't have really made much of a difference to my P&L. Pretty much all of it was just on longs. Now, that is actually a shortcoming of my portfolio currently. It's still difficult to get the right shorting triggers, but I would still be kind of happy with myself that I got about 3%, I think, or it was about 2% returns just from the short side. Ideally, maybe if this was at 4 to 5%, I'd be very satisfied. I wouldn't be expecting anywhere near this sort of P&L on shorts. Even if I got around 5%, I think I'd be pretty happy, just because it's a lot harder to actually do. Now, if we go to correlation, which I think is probably the most important thing this month, this is my April's correlation. Now, if you've watched any of my other kind of recaps, normally this is kind of a sea of green. Now, green, if you don't know what correlation is, primarily you want low or negative correlation. Now, this isn't completely a fair show because this is just 1 month's performance. Normally for correlation, you want to see, over years, etc. And that's how you could actually establish if something is negative or low correlation. But just for these recaps, this kind of paints a picture of how I was correlated for that particular month between the two strategies. Now, you can see here, I've hidden the strategy names. The reason for that is I name all my strategies pretty much what they are. Because it's just a lot easier to track when you're running and testing multiple strategies. Documentation is really important. So I've just hidden them because obviously I don't want to reveal all my strategies, or at least what they're using. Now, as I was saying, a lot of this also is red here. Now, red is high correlation, meaning that's what you don't really want. You don't want a portfolio that's very highly correlated, because most of the time then you're kind of just taking the same trades. You're just doubling your exposure or tripling your exposure. And this was particularly what we would reference as a stress event. Anytime the market drops, I would say 10%, anything like this really, 10% plus, would be normally labeled as a stress event. So you can think of 2020, 2008, etc. Now, this tariff event was actually one of the fastest, I don't think it was the fastest, but it was a top 5 or top 3 drawdowns, at least on indices, in that particular amount of days. It was pretty unmatched compared to a lot of other days. Even 2020 didn't, I don't think, dropped as much, or was about the same as this tariff event. Now, when these stress events happen, normally most markets become quite correlated, meaning you can't really escape that correlation for the most part unless you're trading something very, not globalized. And this is quite shown here. If I compare this to my January correlation, right? So this is from the beginning of the year. You can see this is pretty much all green. There's barely any correlation. We got a bit here, which isn't great, but for the most part, nothing's in red. Nothing's, screaming at me saying, hey, I'm really overexposed, or I'm really correlated in this. But as we can see here in April, it was a different story. So I actually had to add some margin, or just add some capital, I guess, to my brokerage account for this particular month. It wasn't that much. I think it was, I don't know, it was 5 figures or so. That was needed to add as a buffer because obviously I was suffering more volatility, meaning I had to make sure I had capital there that could take on to that. And then also for margin, just in case if I had more volatility and I drew down more. Now, what isn't painted on an equity curve, if I just scroll back up here, after this point, right, of this huge gain, I was like euphoric, right? It was an amazing result. But instantly what comes to mind is, hey, like this is a very outsized move. I have no idea if I'm going to have another outside move to the downside. So that's why I was adding kind of more margin or more collateral basically to make sure that if I did draw down a ton, I was ready for it and I could withstand it. Now, luckily, it kind of chops around. I did obviously lose a decent amount of percentage wise, but nothing in comparison to what I made in basically that one day. Which is fine. I kind of expected it for it to trend down lower because if we look at the market, at least it did become a bit choppy afterwards, or it was just very volatile, to be honest. We had up down moves and then kind of regain days, and then we can also see on these wicks, right? Like this is technically a green day, but this moved all the way up and then just came right back down. So it was insane days, insane price action. That is very rare to see, and obviously we're gonna have to see if the rest of these couple of years with Trump is gonna be the same. Hopefully not. Hopefully it's a bit more stable, but at least it provides a lot of opportunity because you get that volatility. Now, the last thing I want to go over, just to be transparent, I think I lost some money in crypto. Yeah, I lost like 2.6. That is actually split because I trade this account with a friend of mine that's also very good at crypto. We were just taking some trades here and there based on some speculation, basically. So this was an automated tool, but I lost probably like $1,000. I don't know, like $1.5 grand on those trades. But everything else was just fully automated. Now, some of you that have been watching for a while noticed I haven't gone through my small cap performance. I will say I probably removed quite a lot of capital from small caps because I had to transfer over to futures. I can show performance of that if you want, but overall it was pretty boring. It didn't really take many trades and the size wasn't that important to me. So I thought it would be better for me to do more of a dedicated video on all the performance for the automated strategies and give you a bit of a better picture of that. If next month you still want me to show small caps, just let me know in the comments and I'll be sure to include it. But yeah, that was my month.